Hello, I'm MaryAnn. The second quarter earnings season has kicked into gear with markets near record highs, but profit forecasts have been declining more than 2% overall for the S&P 500 companies in the last quarter. So what does this mean for earnings this quarter and the rest of the year? Well, I'm asking today David Sykes, who's Managing Director at TD Asset Management and Portfolio Manager of the TD US Monthly Income Fund. Well, David, what are you expecting for earnings this quarter?
Well, it's interesting. What you mentioned is exactly true. The earnings revisions, the amount that analysts are thinking about that's going to be earned this quarter, have come down slightly. But I think 2% is not a dramatic amount. And if you think about what happened in the first quarter of this year, we had very bad weather. You actually had a negative GDP number. The U.S. economy actually contracted. Right. And I think this time through, you're going to see a little bit better earnings, a little bit better top line, a little bit better bottom line. I wouldn't look for gangbuster numbers, but I think consensus is looking for top line sales to be up in the order of something of 3% and earnings growth year-over-year basis something like 5%.
So we're maybe playing a bit of catch-up from the winter?
Absolutely. I think you're going to get a boost. You've seen the boost in the economy in the U.S. for sure. But one important thing to remember, and I think a lot of folks miss this point, is that the US GDP is not S&P 500 earnings. The S&P is more, it's tied more closely to domestic business spending and global growth as opposed to domestic consumption. So really, if you want to see earnings explode in the US, you really need to see business spending, CapEx, really start to accelerate. We're starting to see that. It's early, but you are starting to see some momentum there. But I think for this quarter, probably good numbers, probably better than expectations, but I think, 3% top line, 5% bottom line, in and about that range is what you can expect.
Now, we've seen a lot of, with markets reaching near record highs, but not a lot of volume and really not, there's been some news, but not anything huge. Has anything changed in what you've seen in the last few months? Has that changed your outlook at all?
I think the one thing that's changed is you've started to really see strong job numbers in the U.S. But if you combine that with what the Federal Reserve is saying, plus what the ECB is saying, central banks around the world are still very, very accommodative. So from my perspective, the one thing that may have changed is that perhaps the Fed, people are now focused on when will the Fed start to tighten. But that's still some ways off. That's, I think, a middle 2015, end of 2015 event. That'd be about the only change. I think you're into the summer doldrums. It's a bit slow. People are on vacation. But I think people are really kind of focusing on the earnings. And then I think August will be a bit slow.
Okay, and what about if you look a little farther out, full year? What are you seeing?
Yeah, so if you look at the S&P 500 for the full year this year, earnings growth is expected to be up about 8%. And lo and behold, year to date, the S&P 500 is up about 7%. If you look at the forward multiple in the market on 2014, we're at about 17 times now. I think that's starting to become a full multiple. So I think from here on out, what you can expect in terms of price appreciation in the market is going to be that earnings growth. 6, 8%. And if you look into 2015, again, consensus is expecting 7 or 8% type earnings growth for the market.
So that's not too bad.
I'll take 7 or 8% any day of the week. I think people are focusing on last year, though, in 2013, where you had a 30% plus year. I wouldn't expect that. I think it's going to be much more muted returns. But to me, a 7 or 8% return is great. That's just fine. I'm very happy with that steady, consistent result.
All right. What about particular sectors? Where do you see the earnings coming from in general or mostly? For
the quarter, it'll be an interesting one. You're going to see some decent numbers out of the energy companies. You've had a nice move in the price of oil. I think that will help. You'll probably have 10% year-over-year earnings growth with the energy sector. You'll probably have robust numbers also in the technology sector. Again, another 10, 12% type earnings number. You won't see a lot of great results, I don't believe, from consumer staples and utilities companies. I think on a year-over-year basis, the earnings growth there will be quite tepid. But again, longer term, for me, the theme now is really becoming about business spending CapEx. You're starting to see a number of factors fall into line. You're starting to see that companies have lots and lots of cash. You're starting to see global growth pick up a little bit, and you're really starting to see CEO confidence, not consumer confidence, but CEOs of real businesses, their confidence is starting to increase. And when that happens, I think you're going to start to see that business spending kick in, and that will really drive the earnings forward in the next 2-3 years.
So who's starting to open their wallets, you might say?
Well, it depends on the sector, but I think what you're seeing a lot is technology. A lot of companies have not invested in hardware and software systems for the last number of years. It hasn't been a great economic environment, and so I think a lot of companies need to update computer systems and software. I think technology is going to be a big beneficiary of that. And also, I think industrials is another area. I think when global growth does tick up, you're starting to see some companies just start to open their wallets a little bit. But if you get that rebound in global growth, I think that will get industrial companies going again as well.
And are there anything investors should really watch for and be careful of?
The one thing that I'm always mindful is that we talk a lot about earnings, but remember that earnings isn't cash flow, and earnings is not free cash flow, and to me there's a big difference there. So I'm always about, I want to buy a quality business with consistent growing free cash flow and dividends that grow year after year. So I would say it's nice to focus on the earnings, and that gives you a general picture, but dig a little bit deeper. Get the press releases, go through the numbers, and look at the cash flow and the free cash flow growth of the businesses. That's really the place to focus.
All right, thank you very much, David.
Thanks for having me.
I've been joined by David Sykes, Managing Director at TD Asset Management. Thanks for watching.